Hi traders, welcome back to another workshop. So this workshop is again a very important one, especially if you're someone who love trading the flags, who love trading the rollover like myself. Two of my main patterns are flags and rollover. One is obviously continuation pattern, one is mean reversion pattern. So let's talk about it and let's move to the chart. So what is a flag? So just a quick introduction description to some of you who don't know what is a flag. A flag technically is a bullish continuation or a bearish continuation pattern, something like this. All right, so what does flag mean? It's very simple. If price is constantly pressing higher, it means if price is surging higher and higher. Flag means we have a tight consolidation, a period of a channel or a period of a consolidation that tells you that buyers are willing to pay at a premium. That's why price are constantly just trying to move sideways. Seems like we're going back and forth, back and forth, back and forth. Then eventually, when buyers are finally stacking up enough buy side liquidity, enough orders, then sellers will eventually give up. So these periods of consolidation or periods of uncertainty are caused by people actually taking profit on their longs. For example, if people who actually bought it here, the smart trader, the institutions, they bought it at the bottom, as price move into their favor, they have to somehow scale out of their position or have to somehow secure some profit. They have to pay themselves first before participating again, or what we call a reparticipation. So when price is in such a strong trend, in this case an uptrend, as price moves further, you will see periods where price just keep moving sideways, back and forth. If you look at the 1 minute, you will see something like this. It doesn't respect any of this structure. Let's say we create on the 1 minute, you will see a support like this happen, gets invalidated, immediately pop back above, but didn't quite make it back to the high, come back down again, pierce through the previous low, pop back up again, didn't quite make it to the high, then come back down again, create new low, low high, something like this. So this is what I refer to a bull flag. All right, very simple. So bear flag, technically the same thing. It means sellers are willing to actually sell at a lower price. And also sellers who sold it at the top need to somehow pay themselves first. They have to somehow secure profit. They have to somehow reduce a bit of sizing or reduce their risk or hedge their position or whatever. That's why you see things like this happen. So what is a rollover? A rollover technically means, let's say on an uptrend example, when price is constantly pushing higher and higher and higher, especially on conditions where things move like this. I'll give you one example. When market is extremely overstretched like this, at the high, that is usually when a rollover actually happen. Go back to example. Let's say price is moving higher and higher and higher and higher. At one point, where the majority, where the retail traders are all chasing onto the buys, somehow someone needs to pay the bill. And that's the basic concept of supply and demand. Market cannot be 24 hours, 7 days a week, just offering higher bids or higher ask. It means a trend can never just keep sustaining without some sort of pullback, without some sort of shaking off the retail traders' action. So as price gets overstretched, that's what we call a rubber band concept as well, we snap back. And the rollover happens where the market seems like it's still moving higher. Then all of a sudden, when everyone's expecting this to move up, it creates some sort of disappointment. And this bear leg is what we call an initiation of a rollover, right? Or initial leg of that rollover. This bear leg is the pattern that we're looking for that confirms that the market is not moving higher. So I want all of you to understand one thing. When price creates a rollover, it doesn't necessarily mean this thing is going to flip 360 degree. It doesn't mean it's going to just completely melt down and turn into a long-term uptrend. Sometimes it could be, I'll give you one good example. We have an EMAs here, 20 and the 50. It could be price coming to value area like the EMAs before the next wave up. Right? It doesn't necessarily mean price is going to just free fall all the way down back to the origin of that uptrend. Or it could be where here we have a major level of support, price is trying to retrace back to a value zone before we move higher, right? So that is a pattern of a rollover. So another example, on the opposite side, as price keeps stretching lower, you will see periods where price keeps failing to create new low. It seems like a flag. So lots of people actually don't know what's the difference between a flag and a rollover, and later on I'll be talking about the specific detail, specific price detail about how you usually see price behave on the 1 to 5 minute time frame. Price failed to create new low. In fact, we are sort of creating new high, then we eventually just reverse back higher. So without further ado, let's go to the chart. I'll give you some of the example. So a bull flag will be something like this, right? I'll give you one good example, like this one. We have an uptrend. We have a period of consolidation where you keep seeing price bounce off the upper band, the lower band, and if you really drop down to the lower time frame, if you drop down to the 30-minute, you can see that this entire process, this entire piece of price action are very linear, very neat, right? And if you drop down to low time frame, can you understand what I was talking just now? During periods like this, price would not respect SNRs, and that is usually when retail traders are prompt to actually make stupid mistakes, sell resistance, get stopped out, just to see price move into their favor. As price breaks a new low again, they go short, get stopped out. Alright, see that entire process are very messed up. Price break through the low, pop back up, didn't respect the high. When people again short into this one, what happened? Pop back up. Alright, so also one clue here is, can you see how price failed to create a highs in between? So that is a period of accumulation, alright, where buyers who bought it at the bottom are actually trying to what? As price move further, take off profit, feel like price still wasn't able to get back to the high, take off profit, take off profit, take off profit. Or some of these sales could be because there are people on the opposition are actually trying to take advantage of this short-term pullback. Then there are people also short into the market. People who shorted here are technically the retail trader, and they get stopped out, getting wiped out as a liquidity pull, a liquidity grab. Then price continues making fake new lows, eventually pop back up, and guess what? Then we just sort of pushed all the way, go back to the high. So that is a bull flag. So I'll find you one example of a bear flag. If you go back to the high time frames, look at the 1 hour. A classic bear flag is something like this. Can you see it here? We have a nice sell-off, period of consolidation, very neat. If we draw an upper and a bottom trend line, very neat. Put on a replay mode, drop down to the 50-minute. Can you see that? Very clean, respecting the upper band and the bottom band. And also, if you zoom in a little bit, did price respect the structure? It didn't. See, if you really pay attention to this one, break through the previous high, come back for a retest, guess what? Pull back deeper. So people who actually long it here with their stop loss underneath, these candle will stop them out, right? Imagine where they place their stops. For people who chase the breakout, get into the longs, imagine if they buy there, guess what? They get stopped out again. So this is that kind of condition where people are just trying to accumulate or distribute liquidity. If you place your stop loss again under this low, what would happen? You get stopped out by this candle. If you chase the buy over here, guess what happened? You get stopped out by this massive sell-off. So periods like this is exactly when you need to be very aware. And how should you trade a flag? We'll just get into that. I was thinking about talking about this in a next workshop, but let's talk about how can you actually trade a flag. So a flag is very simple. First thing first, when it comes to trading a flag, there's two types entry. I've talked about this in one of our previous flag workshops. I'll also link it later in the comment box there. So when it comes to trading a flag, the key thing you have to know is that this is a continuation pattern. So if let's say you get into a flag and it doesn't run, you need to get out of the position. Alright, remember again, flag is a continuation pattern. So if you are trading a continuation pattern, make sure you are trading at the right condition, means market is in a trending condition. Second thing is, if the market isn't moving, if you're trading a bull flag or a bear flag or any pullback setups, you need to get out of the trade. Because when you are taking setup like this, your initial thesis must be, I'm expecting the market to run. So if the market isn't moving, you need to get out of the setup. Very simple. So if you look at this one, same thing. There are two ways to actually trade a flag. The first one is what I call an aggressive method. Second one is what I call a conservative method. So an aggressive method technically means you're trading a flag anticipating the turning point. So assuming if you have a look at here, put on the replay mode again, an aggressive entry would be after you seeing price sort of forming a flag, because based on your experience, based on your backtesting, based on your price study, you know what a flag looks like. Like for myself, before a flag happens, I know market is going to do a flag. So in that way, after seeing that price feels like it's going back and forth, we have a nice precursor here, beautiful trend, beautiful consolidation. Then therefore, let's say you take a long there, stop loss above some of these minor highs, then target at the low. This is what I call a aggressive entry. So what is a conservative entry is to actually wait for a break of the flag. So B, conservative entry, break of the formation, anticipating turning point. So very simple. A, we talked about this one just now. You are anticipating when would the flag ends and having a protective stops. B is after you see that the bottom band has been broken, then you wait for either a retest of this kind of structure, or you wait for the EMA cross. You can set your own criteria. Like for example, if your confirmation is, I want to see price break under the bottom band when price is in a bear flag. At the same time, I want to see the EMA cross, 20s under the 50, then therefore I can enter the market. Like this. So this is A, this is B. Aggressive entry, conservative entry. So what's the pros and cons of a conservative and aggressive entry? Is mainly your price position. And the price position ultimately affect the way you manage the setup and your risk reward ratio. So let's talk about the pros of an aggressive entry. The good thing about conservative entry, an aggressive entry, this one, is you have a good understanding of the pattern itself. You know when a flag is going to happen before it actually happens. Therefore, you set yourself ahead of the crowd. Let's say you take a flag right there and price starts to run into your favor. When price breaks through the bottom band, you can technically already do some sort of protective measure. You can pull stops to break even. Let's say price break through the band. If we put on a replay mode, after seeing that, hey, price seems like it's breaking through the bottom band. So right now I can move stops to break even and let the position to run. So you're eventually setting yourself beforehand, before the crowd. So let's talk about the ugly side, the cons about aggressive entry. The bad thing about an aggressive entry is you are subjected to getting stopped out instantly. So even if you have a conservative entry, you might still get stopped out instantly. But when you're playing an aggressive entry method on a flag, you are technically predicting the turning point. So that being said, you don't have a lot of confirmation. You don't have as many layers of confirmation as compared to waiting for a flag to break, then you participate here. Again, good thing is you enter at a good price, way better than someone who's actually looking for a conservative entry waiting for the break. And also that way you can actually have a tighter stops, have a wider risk reward. Bad thing is, let's say this candle just completely reversed up, you get stopped out without knowing, without any mercy, I can say that. So what is the good thing about conservative entry is, again, you have more layers of confirmation. You actually wait for another wave of impulse to come in, like this one. This is what we refer to an impulse wave to actually happen. Identify that, hey, the bottom band has been broken, then you join the retest. If you want to add another layer of confirmation, it could be a structure, it could be a level. If you want another layer of confirmation, it could be the EMA cross, which is the 20 under the 50, the blue line and the red line. So what is the downside of a conservative entry? First thing, there are times where a flag loves to trick people and pull all the way back to the high. If you go back to do your back testing, you will actually see sometimes flag does this. Very tricky market. It seems like it's breaking under the flag. All of a sudden, when you start chasing the low, when you start entering right here, conservative entry, it does this. Drop a little bit, pull all the way back to the flag's high, come all the way back down. Then that forms a double top, or that forms an equal high rejection. So that is the downside. The cons about a conservative entry. First thing first, your price position as compared to this one, who do you think has a much better price position? Obviously, aggressive entry. Who do you think will have a tighter stops? Aggressive entry. Alright, so let's say if you enter based on aggressive entry, when price does this, you have time to break even, you have time to reduce your size, you have time to trail your stops to half an hour, 1 hour, whatever. But if you're having conservative entry, if you're wrong, it could be really fast as well. So you really have to measure how you want to trade a flag. There's no right or wrong, but yeah, just think about it. Let's talk about a rollover. So what is a rollover? If you want to go back to the flag, you can always rewind back to the video, but let's not waste any time and let's talk about rollover. Earlier, as I said, a rollover is period where market seems like it's forming a flag, but we have a period where it keeps doing things like this. Earlier when I talk about a flag, I say that we have a messy a zigzag formation, right? Means price doesn't quite respect resistance or support, it just keeps doing things like this. That is a flag. All right, it seems like it's breaking above the previous high, come all the way back, seems like it's breaking under the previous low, spike all the way up, doing things like this. That is period of agreement, right? A rollover, if you zoom into lower time frame, you'll see price do this. Overstretch condition, seems like a bull flag, but you'll see price do this. The big thing, the main difference between a rollover and a flag is a rollover generally, from a bearish reversal perspective, we're talking about an uptrend, has potential to reverse back down. It will respect support. Support turns resistance, support turns resistance. So we'll go deep into this later. You can actually see here we have a nice uptrend. We want to create new high, failed. We want to create new high, but somehow there are sellers actually shorting at the previous structure. Sellers shorting at the previous structure. Sellers shorting at the previous structure. So that is the difference between a rollover and a flag. A flag is things like this. We have no respect of the support or resistance. We have no respect on this one. However, on the rollover, this is a flag. A rollover, we have a respect of the previous structure, disrespecting the previous structure. See that agreement? Disagreement. Sellers actually say, hey, that's expensive, let me short it. That's expensive, let me short it. Sellers have no power to say anything. See the big difference here? So let's go into the chart and let's look at some specific example. Remember, a flag is a continuation pattern. A rollover on the other side is a mean reversion pattern or a reversal pattern. Let's see if we could get any sort of example. Let me see. It's not easy to find a rollover because it's not a very common pattern, because usually when price form a rollover, the sell-off is going to be very, very intense. Here we have one. So put on the replay mode. So let's talk about this one. If we drop down to the 5 minute, can you see this? Seems like we are forming a bull flag here, right? If this is on the 5 minute, see that bull flag? See that break of structure when everyone is chasing the buy? See this? This is where everyone has the potential to actually chase the high, expecting this to go up. But what happened? We have a break of the flag, failure. See that immediate disappointment? Go back to the early part of this video. I talk about rollover being a disappointment. It has tendency to create the first wave of disappointment, wipe off the people who are actually expecting price to continue moving higher. Rollover could be a bullish reversal, could be a bearish reversal. After studying this, if you want to test the other side, just flip the example around. See this? Then guess what? Big wave of disappointment. And look at what happened here. Pay attention to what happens here. Respecting previous structure. See that? We have a solid break and retest. Again, see that? Break and retest. When everyone's expecting this to go up, maybe they are looking at this from a previous support continuation perspective, but we know that the difference between a bull flag and a bear flag is disappointment. Bull flag is a period of agreement. A rollover is a period where people actually disagree with the pricing. Then therefore sellers actually take advantage. As price started to sell off, everyone's go back chasing the high. Guess what? Sellers again step back in at the previous structure, shorting this. Then we have a beautiful what? Reversal here. And that is exactly when market completely flip all the way around. So let me find another example for you of a rollover. Okay, this could be one as well. It's not the perfect one, but if you put on the replay mode, you can actually see here when everyone's chasing the short, because here we have a massive long-term flag. See that? No respecting previous structure. We just keep grinding upwards. Massive sell-off. Here we have what? A period of uncertainty. This is what I refer to a period of uncertainty. Then we have what? A respect of previous structure. We're trying to go new low, failed. Trying to create new low, failed. Go back up, respecting the previous structure, push back up, come back, push all the way up. So that is not the perfect example of a rollover, but yeah, I hope all of you learned something new from this workshop. Remember, the difference between a flag and a rollover are very small. So if you want to master these two patterns, you really have to zoom down to the 1 to 5 minute and look at how price behave at the very minor structure, at the very minor detail. All right, And again, I hope you all learned something new, and please take full advantage of this workshop, and please go and test it out, go and validate it, and see if things that I say actually make any sense. And yeah, I'll talk to you later. Bye bye.